Today, the Bank of Canada kept its finger on the pause button and did not increase, but also did not yet decrease its interest rate. For most of us, these announcements don't directly impact us as they affect interest rates on variable rate mortgages and on lines of credit. The bond market movement is what affects the fixed interest rates more, but I will talk briefly about that as well. So the Bank of Canada held its target for the overnight rate at 5% and continued its policy of quantitative tightening. That means they're not buying bonds anymore, they're selling them off. This move was widely anticipated as the market conditions and the economic forecasts had pointed toward a rate hold. Economists and markets had been predicting this third straight rate hold in a row, shifting the focus from the possibility of further rate hikes more toward the timing of the bank's first rate cut. But the Bank of Canada, as they have been, still continues with its messaging and warning to us that if inflation doesn't continue to behave and drop in the direction it's supposed to, that the bank is prepared to increase the rate again. That said, there are lots of reasons that economists don't think that the bank will increase its rate any further. So with Canada's economic growth stalling over the middle quarters of this year, 2023, and real GDP contracting, higher interest rates are restraining spending. That's kind of the point. This, combined with a slowdown in the economy, is reducing inflationary pressures, with the CPI, or Consumer Price Index inflation, easing now to 3.1% in October, the most recent month available. Now, meanwhile, a discussion is brewing in the economic community about the future trajectory of interest rates. Renowned economist David Rosenberg anticipates that the bank will need to cut its policy rate by 2 full percentage points over the next 12 to 18, maybe as high as 24 months, potentially starting that process as early as March or April of 2024. This is a significant change considering the upcoming wave of mortgage renewals and the financial strain that it would put on households. Because of higher mortgage payments, what we would find is if too many mortgages renew at these higher interest rates, that it pulls a significant amount of money from the economy. And since that money is now going toward mortgage payments, it's not going toward spending other things that keep our economy going and help with the growth. So it would actually set us up for a long and a difficult recession. We can hope that the Bank of Canada understands this, and I believe that they do. They are smart people, even if we don't always agree with them or like what they do. But we can hope that they understand this and that they will proactively work to prevent just that. Now, separate but related is the 5-year Government of Canada bond. Yield rate on that has been trending downward over the last month or so, leading to a decrease in fixed interest rates. In the spring, the bond and correspondingly the rates hit a low point, and it happened when a few of the banks in the United States failed. But over the summer, we did see a steady climb of that. So from the high point that came in October, the bond yield has dropped about 1%. And so as a result, we will likely see lenders across the country start to offer rates even below 5%. We're getting a lot closer now than we certainly were. And so that'll be the first time that we'll see rates under 5% since last spring. And so this is actually a really great indicator as it suggests how mortgage rates are going to continue going over the coming months. Now, economists from the major financial institutions are predicting that the central bank is going to hold the rate that it's at right now for at least the next 6 months, with a majority of them expecting a reduction in the second quarter. So that's where the April-May rate drops are anticipated. So in the second quarter of 2024. So to recap this, the Bank of Canada's decision to maintain the overnight rate, or its policy rate, of 5% is in line with the market expectations, and it reflects the current economic conditions that we're seeing here in Canada. However, with the easing of inflation and the downward trend in the bond yields, there is really a good case and growing speculation about a potential rate drop or decrease in those rates in the near future. As always, if any of you have any questions or you want to discuss How these changes or developments might affect you, your financial institution, maybe your upcoming mortgage renewal, maybe your pending purchase plans, please feel free to reach out to me and to my team, and we would love to help you understand how this applies to you specifically. Thank you so much.